concept that lies at the core of a lot of macroeconomics and macroeconomic policy is the idea of an aggregate consumption function. Now, that's a fairly obscure sounding animal, but it basically is relating what people buy to their income at the aggregate level, at the economy-wide level of how much people will decide to buy goods and services given different levels of income. It's a function. In this case, it's a function of multiple variables. Again, when you look at the separate math concept video to remind you of what that means, which relates, again, income to what individual consumers and firms buy for current consumption. And we will also use an equation of a line in this. Now, this consumption function and income is going to be defined in part by something called disposable income. Now, sometimes I've said a number of videos before, economists use really weird language. Disposable income. What, throw it away? I mean, you're going to dispose of it? What in the world? Why do they use these words? I don't know. Disposable income is the income that you've got after taxes have been taken out. This is after tax income. It's how much of your paycheck you get to keep after taxes have been removed. And that's what you can spend or dispose of. It would have made a lot more sense to call it spendable income, I suppose, but there it is. That's the term that's used. So we're going to relate how much private agents, firms, and individual consumers, we're going to relate their income and their tax burden to how much they consume. Now, the way I'm going to write this, generally, is to say that consumption is going to depend on the income. So Y is income. And T is taxes. Now, so we're talking about, again, a function of multiple variables, that the overall consumption is going to depend on both the level of income and the tax rate. So, for the tax burden. Now we're going to talk about the equation of a line. So I'm going to relate the consumption, and I'm going to have a very simple, well, actually, before I get there, Y minus T is going to be the disposable income. Why do I write that? I take my income and I subtract how much taxes are. So we've taken out the payments to the government before we get our final paycheck that we can use to buy stuff. So we're going to say consumption is a function of disposable income, and I'm going to write this in the following way. This is an equation of a line, and I'm going to have an intercept, okay, again, equation of a line, go take a look at that video. We've got the equation of a line plus B, some parameter, okay, A and B are both parameters. Go look at the economic terms to see what that means. And then I'm going to multiply that times the disposable income. This, I'm going to say that both A and B are both positive. Both A and B are greater than 0. Consumption is a positive function, has a positive relationship with disposable income. The higher my disposable income, the more I'm going to have to spend on goods and services. Okay? So it's a simple linear equation. Now let's look at that in more detail. So again, the consumption function is going to be A plus B times Y minus T. B is going to be what's called the marginal propensity to consume. Again, economic jargon. This is saying how much of an extra dollar that I get. So if I get a dollar's worth of extra income after taxes, how much of that dollar will I spend? So if I get one more dollar, I can either save it or I can spend it today on goods and services. So let's say out of that dollar, I'm going to spend 80 cents. That is the marginal propensity to consume. Again, propensity, I don't know. It's the term that we use. It tells you how much of your income you'll spend. And if we're talking about this consumption function as the economy as a whole, then this is the overall amount of income that will be spent on current goods and services. So here's why this is income minus the tax burden multiplied times B. That gives you how much extra income, how much extra consumption you will undertake. Now, one thing about B, since you're talking about, how much of your income will you spend, that B is going to be a fraction between 0, 1. It's some fraction. It would be 80%, 0.8, or 0.9, or 0.5, whatever. But it's going to lie somewhere between 0 and 1 by assumption. So we're saying that you're not going to consume more than the income that you've got. Okay? So this consumption function we'll be using to build up some of the economic models and how how the level of consumption will determine how much economic activity will occur. But important to understand this relationship in order to build up that other apparatus.